Good morning, everyone. On behalf of Brickwork Ratings, I'm delighted to welcome you all to today's webinar on liquidity and banking and financial sector. My name is Sonali Mittal, Associate Director Ratings at Brickwork Rating, and I will be presenting this session. It's a pleasure to have you all here, and I hope you find the session insightful and relevant. Joining me today is Mr. Hemant Sagre, Director at Brickwork Ratings, who will be adding his perspective during the discussion and questions and answer with his expertise in the financial risk segment. Before we dive into our discussion, let me briefly introduce Brickwork Ratings. We are one of India's leading credit rating agencies, accredited by RBI and recognized by SEBI. We provide independent and credible credit ratings, research, and risk assessment services across a wide spectrum of industries, including banking, financial services, infrastructure, and corporate sectors. Let's start by looking at the bigger picture. Liquidity, in simple terms, is the ease with which money moves from the financial system, from central banks to commercial banks to business and households. Over the past year, we have seen RBI take a calibrated approach in managing system liquidity using tools like VRR auctions, CRR adjustments, and government securities operations to ensure balance. As of June 2025, net durable liquidity in the banking system hovered around rupees 2 to 3 lakhs crores in surplus. But with signs of tightening due to advancing credit growth and higher government borrowings, inflation management, foreign capital flows, and fiscal operations have all played a role in liquidity shifts. For instance, a spike in crude prices or a spike FPI outflow can instantly drain rupee liquidity. Similarly, sudden dividend payouts or advanced tax outflows impact money markets in the short term. All this highlights why it's important to manage liquidity risk, especially for the banks, NBFCs, and financial institutions that play a key role in lending and keeping the economy running smoothly. Liquidity stress is often an early warning sign of financial trouble and can come before credit issues. That's why it's important to keep a close eye on their liquidity and manage it well. In this webinar, we will delve deeper into the dynamics of liquidity management and provide insights into best practices for managing adequate liquidity levels. We will also discuss the regulatory framework surrounding liquidity risk management and implications for banks and NBFC. So let's get started. Before get Before we get into the specifics of liquidity risk, let's take a moment to align on what we mean by liquidity, especially in the context of financial institutions. Liquidity, in simple terms, refers to the ability of an entity to meet its short-term obligation as and when they fall due, without incurring unacceptable losses. For banks and NBFCs, having enough liquid assets or funding sources to manage daily operations, repay borrowings, honor deposit withdrawals, and support disbursements, even under stressed market conditions. Now, there are two sides to liquidity. One is market liquidity and funding liquidity. Market liquidity is about how easily assets can be converted to cash without impacting their price. Funding liquidity, which is our primary concern today, is the institution's ability to raise funds as and when needed. In BFSI space, we have seen multiple episodes that tested system-wide liquidity, from the global financial crisis to the recent defaults by big players of NBFCs, and more recently, the pandemic-led disruptions. Each of these highlighted how quickly liquidity can tighten and how critical it is to maintain buffers, contingency lines, and diversified funding sources. For credit rating agencies, liquidity is a foundational pillar in assessing creditworthiness. A borrower's ability to service debt on time, even during the period of stress, often hinges on how prudently it has managed liquidity. Now that we have defined what liquidity means, let's move to the key drivers of liquidity risk that can disrupt an institution's ability to access funds or convert assets into cash when needed. So let's begin with market volatility. Sudden change in interest rates, currency value, or global events like war or rising oil prices can quickly shake investors' confidence. We saw this happen in 2018 when some of big players from BFSI sectors defaulted, and even more clearly during the COVID-19 crisis or during financial year 22-23 when RBI raised repo rate from 4% to 6.5%. In such times, market become volatile and investors prefer safer options. This make it much harder for financial institutions, especially smaller or lower rated NBFCs, to raise money. Another fundamental and ongoing challenge is asset liability mismatch. Many financial institutions fund long tenor assets, such as mortgage or infra loans, using short term borrowings. While this model works under normal conditions, any disruptions in the rollover of liabilities or delayed inflows from assets can create liquidity strain. The mismatch between the timing of cash inflows and outflow is one of the most critical risks to evaluate. Then come regulatory pressure, which can act both as a source and a mitigant of liquidity risk. Tighter liquidity norm like LCR, SLR, or exposure limits increases compliance requirement. While they strengthen stability, they also restrict flexibility, especially for smaller NBFCs or during stressed period. Then another major driver is a dependence on wholesale funding. Heavy reliance on market borrowings like commercial papers or NCDs make institutions vulnerable to sudden market shocks. If confidence dips or risk aversion increases, access to these funds can dry up quickly. Then comes digitalization effect. Digital banking has made deposit flows more volatile. As customer can move money instantly across institutions. For lenders, this means liquidity can shift quickly, especially during panic or negative news events. In summary, liquidity risk in BFSI is multidimensional. Some drivers are structural, like ALM or wholesale funding. Others are cyclical, like market volatility or regulatory interventions. For CRA, it is crucial to look at the current liquidity buffers while evaluating the institution's resilience under stress. Having understood what liquidity risk is, what drives is, it's important now to look at how the regulatory framework has evolved to monitor and manage this risk. Let's start with the foundation, the Basel III liquidity standards. Basel III introduced two key metrics to strengthen short-term and long-term liquidity risk management. One is LCR, that ensures that bank holds enough high-quality liquid assets to withstand a 30 days stress scenario. Liquidity coverage ratio. Think of liquidity coverage ratio like a financial first aid kit. It tells us whether a bank or NBFCs has enough easily sellable assets like cash or government securities to survive for 30 days if funding suddenly stops. So if there is a market panic and depositors start withdrawing or lenders pull back, the institution should be able to pay its due for one full month without depending on new borrowing. RBI requires this buffer to be at least 100% of expected net cash outflows in a stressed situation. Now, NSFR is one more long-term health, not just short-term survival. It asks, is your long-term lending funded by stable, reliable sources? And SFR ensures that institutions use long-term sticky funds like long-term deposits or equity to fund their long-term loans. This help reduces dependency on short-term borrowing that may not be available in bad times. India adopted these norms in a phased manner. For scheduled commercial bank, LCR was fully implemented in 2019, requiring 100% coverage. And NSFAR became effective from October 2021. This mirrors the Basel standard but tailored for Indian financial institutions. One of the latest regulatory move by RBI to further strengthen liquidity buffers is the introduction of an additional 2.5% runoff factor on less stable retail deposit under the LCR framework. With this new rule, the RBI is saying from 1st April 2016, 2026, bank will need to assume that an extra 2.5% of such less stable retail deposit could run off in stress, and they must hold additional liquid asset to cover that. It also brings liquidity coverage ratio norms more closely in line with the international Basel III expectations, which already suggest stricter treatment for such deposit. Let's have a look at a real picture of LCR and SFR in the banking and financial sector. So here we are showing a chart. That chart represents the liquidity coverage ratio, and the net stable funding ratio across four key periods: September 23, March 24, September 24, and March 25, highlighting how the liquidity position of the BFSI sector has evolved. Both LCR and NSFR values are consistently above the regulatory requirement of minimum 100%, showing that banks and financial institutions are maintaining a comfortable liquidity buffer. The LCR peaked at 149.6% and NSFR at 132.4% in September 2024, indicating exceptionally high short-term stable funding coverage, possibly in response to increased market uncertainty or regulatory tightening. It was a result of cautious liquidity management due to global uncertainty. In March 25, while both ratios dipped slightly from September 24 peak, LCR at 132.6 and NSFR at 126.3%, they remained well above regulatory threshold, reflecting a stable and resilient liquidity profile. The chart reinforces how RBI ongoing supervision and liquidity norms are helping institutions maintain healthy buffers to meet both short-term and long-term obligations, even amid changing market conditions. This kind of prudent liquidity positioning reflect well on the system stability. However, as the credit demand picks up and interest rates stabilize, we may see a gradual normalization of these ratios in the coming quarter. So now for the remaining presentation, I would like to invite Mr. Hemant Sagre for present remaining.
Thank you, Sonali. Now that we have looked at the system-wide liquidity trends, let's shift focus to smaller players such as base layer NBFCs, smaller housing finance companies, cooperative banks, and MFIs. Unlike large banks or upper layer bank NBFCs, these players often have very limited direct access to capital markets, and their funding base is usually concentrated and relationship driven. This makes liquidity assessment both more challenging and more critical. Let's look beyond reported liquidity ratios and assess whether entity actually raised funds when needed quickly and reliably. For these entities, analysis goes beyond just looking at the numbers. Of course, we analyze quantitative lens, studying their asset liability maturity statements or cash flow statements to understand the inflows and outflows over a various time period buckets, assessing if they have a surplus or a shortfall in the near term, particularly over the next 1 to 3 months. A simple yet important indicator we use is how many days of cash coverage they have. Can they cover 1 month of outflows comfortably without fresh funding? But these numbers often don't tell the full story, especially in smaller setups where liquidity reporting is less standardized or where delays in collections are not fully reflected. This is where qualitative judgment becomes very important. This is when understanding the management's approach to liquidity becomes important. Do they maintain a conservative buffer at all times? Is their treasury function proactive or reactive? How do they plan for contingencies? We also look at the funding relationship. Are they overly reliant on two or three lenders? Or do they have a well diversified borrowing profile? A lender network that includes banks, DFIs, and mutual funds is more resilient than one that depends heavily on a few institutions. For instance, did they face rollover issues during the COVID lockdown, or were they able to manage without disruptions? In many cases, these small players are part of a larger group or backed by a financially stronger parent. That's where parental or group support comes into the picture. Even if the liquidity position of the standalone entity appears weak, the presence of a supportive parent or a promoter group can significantly mitigate the liquidity risk. The nature and strength of the support, whether they have been capital or liquidity infusions in the past, and whether there is a demonstrated willingness and ability to step in during stress period. So, when it comes to assessing liquidity in smaller entities in the financial sector, relying on ratios alone is not justified. Instead, the management's attitude, funding leg flexibility, and the strength of institutional backing form a holistic view. In the end, the question remains the same. Can these entities raise funds when needed and do it without causing a disruption to its operations or reputation? Move to the next slide. To take our discussion forward, now let's look at how liquidity shocks are actually assessed at the system level, especially through stress testing of NBFC's asset liability positions. The chart here is based on the RBI's FSR report, which was published in June 2025, wherein they conducted a liquidity stress test across 158 NBFCs using structured framework. The objective was to evaluate how NBFCs would cope if they were suddenly faced with a liquidity crunch. Others, either due to an unexpected rise in their outflows or a simultaneous decline in their expected inflows. Framework works on a very fairly intuitive logic. Assume a sharp increase in the NBFC's cash outflows across different time buckets, and at the same time, assume that a portion of the expected inflows do not materialize. This creates a stress liquidity scenario, or what we would call a worst case mismatch. The stress scenario applied in this table assumes baseline scenarios, medium risk scenarios, and high risk scenarios. The baseline scenarios is based on projected outflows and inflows over the next 1 year. While for medium risk scenarios, it is assumed a 5% decrease in inflows and a 5% increase in outflows. While the high risk scenario assumes 10% decrease in inflows and 10% increase in outflows. The conservative assumptions are applied across maturity bands 8 to 14 days, 15 to 30 days, and so on. This helps simulate how the liquidity gaps widens under stress and whether the NBFCs can still manage without support. Now, if you look at the table from the report, you will see that under the stress scenarios, the results revealed that number of NBFCs which may experience negative cumulative mismatch of over 20% in the next 1 year would be an increasing rate. On base case scenario, it will be 1, while in case of medium risk, there will be 2, and higher risk, it will be 3. Under these three respective scenarios, it tells us that NBFCs have been holding stronger and liquid asset position and are better placed to withstand sudden funding shocks. This is likely to due to a combination of regulatory discipline under the LCR framework, improved internal treasury risk practices, and perhaps also the cautious stance adopted in the run-up to global uncertainties earlier in FY20. Next move, we can move to the next slide. Now, the concepts and frameworks we have covered so far set the stage, but let's see how they play out in the real world context. Examining past events helps us prepare for future liquidity challenges. Let's revisit one of the liquidity events in the Indian financial system, the financial crisis of 2018 on NBFCs. In 2018, a leading infrastructure financing company defaulted, sending shockwaves throughout the sector. As the result, a sharp spike in credit spreads and panic among investors. Corporate borrowings rose by about 100 bips over a short period, that is up to 6 months. And mutual funds scaled back exposure to NBFCs by 20% YOY. The markets for NBFC papers dried up almost overnight. What made this crisis more intense was the fact that many MBFCs were funding long tenure assets using short term borrowings. This default exposed the structural ALM mismatch across the sector, which until then was not fully priced in by the stakeholders. From a rating agency's perspective, this event reshaped how we think about liquidity risk, not just in terms of balance sheet ratio, but in terms of market access, rollover risk, and funding concentration. In response, both regulators and institutions took several corrective steps, including tighter supervision, LCR implementation for large NBFCs, scale-based framework for NBFC classifications, and stronger governance norms. But this crisis remains a reminder that liquidity can vanish rapidly, and even the best capital positions can't substitute for poor funding resilience. This crisis was a turning point and it elevated liquidity risk to the top of the agenda for all stakeholders in the financial ecosystem. Can we move to the next slide. At CRAs, liquidity is a critical pillar for analytical framework, especially for financial sector entities where CRAs assess liquidity. They don't just look at ratios in isolation. Instead, they classify an entity's liquidity profile across broad buckets, typically superior, adequate, stretched, and poor, based on both quantitative and qualitative factors. We have seen this has been a good tool in the recent times. Since January, we have seen where the liquidity stress has increased. We have seen downgrades happening. And simultaneously, also, if the liquidity has been improving, there have been seen improvement or upgrades in the rating. Next slide, please. As we close, As we close sessions, let's look ahead at how liquidity risk is likely to evolve and what institutions can do to manage it better. The future outlook for liquidity in the BFSI or the banking financial space sector is shaped by a mix of regulatory tightening, market volatility, and evolving funding models. While system liquidity remains stable today, we are clearly entering a more normalized environment, with the RBI reducing excess liquidity and funding costs gradually inching upwards. This means institutions can no longer rely on abundant low cost funds. They'll need to manage liquidity more actively and more strategically. Regulatory and expectations, Regulatory expectations are also rising. The RBI has already brought LCR, NSFR, and LM disclosure into sharper focus, not just for banks but also for NBFCs under the scale-based regulation framework. Going forward, we expect more granular liquidity stress testing, real-time monitoring tools, and public disclosure to become the norm, especially for large and systemically important institutions. Let me briefly highlight a few best practices that are becoming critical. First and strong. First, the strong LM discipline. This means that just matching maturities on paper, not just matching maturities on paper, but also stress testing inflows and outflows under multiple scenarios and ensuring adequate buffers are built in. Second, about diversification of funding resources. Thirdly, maintaining committed credit lines and unencumbered liquid assets. Fourth, central treasury governance and early warning signals. And finally, transparency and communication. So, to summarize, while the liquidity environment is evolving, those who embed these practices early are more likely to maintain stable credit profiles and investor trust. In today's environment, liquidity isn't just about survival, it is a marker of good governance, reputation, and long term sustainability. We hope this session helped connect regulatory framework, rating methodologies, and real world stress events into a cohesive view on liquidity risk. Thank you. We look forward to your questions. A question from Kaushik. It says, is repo likely to change in short term? Sonali, you would like to take it?
Sir, you may continue with it. So,
The repo rate is a factor of the liquidity stress. RBI does its stress testing as the tools we have actually covered up. It has a wider database to look at the liquidity. The repo rate changes in the recent times are a factor of what they are planning to achieve on a longer term. Any more? Thank you, Bishop. How is stress testing done for liquidity by RBI? You, I would request you to refer to RBI's FSR report. They have a more elaborate way of testing. One of the tools we have actually covered it in our description was on stress testing these various tools on on giving a 5% deviation or 10% deviation. What is liquidity mismatch? Is basically a mismatch between your cash inflows and cash outflows. That the near-term cash inflows should be stronger. If inflows are not happening, what is the adequate buffers that have been built in? Are there any liquid other assets which could be liquidated at a shorter period? A more holistic approach is followed by RBI, where they have a complete database of all the NBFCs or all the banking system in their portfolio. They bifurcate based on the scale-based regulation where the NBFCs are categorized into the upper, lower, and upper, middle, and the base layer categories. Right now, no NBFC in the top layer. So based on this categorization, they follow this approach on the stress testing. Thanks, Harish. Hari Krishna. This is where we also are looking at. That's when we said that merely looking at, that the next question is, since there are no clear regulatory requirements on liquidity for base layer NBFCs, how is liquidity typically analyzed for them? This is where exactly our presentation was to assess the liquidities of these entities, which are smaller NBFCs where disclosures will not have a rate. So this presentation was an attempt to have that the smaller NBFCs make their disciplines, liquidity disciplines, in line with the counterparts on the higher or middle or upper layer. What are the tools that they'll have to implement? They have to have certain, with the limited resources, they need to have good ALM practices to be mentioned. Like they have to match their inflows vis-a-vis the outflows. What are the sources of inflows? In case of those shortfalls or any extended receivable days, how they are going to match them. That is where exactly we come in. Yes, there is no clear regulatory requirements on base layer. I hope I clarified your points. In case we don't have anything, we can close. Well, thank you everyone for joining in for this session. Brickwork Ratings will come back with more insightful sessions, both in BFSI and other segments. Please keep in touch. Thank you.
Thank you, everyone. Thanks for joining us. Thank you.